Hey, Kurt, you're a little dark on your screen, just so you know.
Is that right?
Lighten it up a little bit. We're going to do fixed income today, as we do with all of our speakers. We introduce them using the Ask First form, and that's a little better. And can you pull up your Ask First?
Yes. Just share my screen here.
Yeah. You got it on the second page there. There we go. All right. You have a master's or other advanced degree, and it looks like it's an MBA from the University of Virginia. Is that correct?
That's correct.
And how many years have you been in the financial services industry? Since you were 5 years old.
18.
18.
18.
Yeah, God, I knew you when. Give us a little bit of your background.
Sure. So I started on the institutional side of the investment management business. Coming out of college, I worked at PIMCO in Newport Beach. Looking at their building right now, just around the corner. And I was there for about 5 years. I worked at another institutional investment management firm where we specialized in municipal bond portfolios for ultra high net worth individuals. And then after about 8 years working on the institutional side, I moved over to working with individuals and families in 2011. And so for the past, I guess, 9-10 years now, I've been doing that. So
okay. And not only that, your dad was a financial advisor for all his years. So you've been around this for a few years.
That is correct. That's true.
And your Series 65 is not really a license. It's more of a registration. And so you are a fee-only fiduciary registered investment advisor.
Correct. Yeah, we don't have any licenses here at the firm that enables anyone to take commissions.
Talk a little bit how you're paid.
We're paid as a percentage of assets under management. We have a declining annual fee schedule. So when clients come in, they start at a specific rate. And then
what is that rate?
Depending on size, it could be
500,000 I'm going to give you to manage.
Yeah, so it would start at 1.25% in year one, and then decline 5 basis points every year until you get to 75 basis points. So first year would be 1.25%, the second year would be 1.2, 1.15, and so forth. And then in year 10, you'd be at 0.75%. And the reason we do that is it, you know, in our business, a lot of the work tends to be heavier on the front end. So it aligns the fee with our workload, because over time, as clients become more comfortable, candidly, you're just not doing as much heavy lifting. So, and then the other thing is your account balances should grow over time. So that way you're paying a lesser fee, less than 1% on the larger balances.
And then is financial planning included in that, or is that a separate charge?
It's included.
It's included. And do you give any kind of free looks if somebody wants to come in and meet you and see if that there's a match?
Yeah, no, absolutely. We only charge any fee if we're managing assets. So yeah, we speak with folks all the time and happy to provide advice on their financial situation, and whether that leads to a relationship with our firm or not, either way, we're happy.
They're comfortable with that. And how much do you have under management at the present time?
A little bit over 500 million.
500 million. Alrighty. And how many staff people do you have catering to those clients?
Well, there's 8 people at the firm, 4 on the investment side, 4 on the administration and operations side. So
super. And then I'm going to assume that on your Ask First form that financial products and affiliated organization, that is false. I'm assuming that.
Correct. Yeah, we're 100% independent employee-owned firm.
Yeah, and you do not sell annuities, insurance, or mutual funds, or affiliated with anyone who does, correct?
Correct.
Okay, And then your contact information is below that. And then you certify under penalty of perjury that the above is true and correct.
Yes, I do.
But the reason why we do all this is because the number one reason why people say they go to their financial advisor is because they're a good guy. They're really nice. And I think nice is really important because you are really nice, but you also have the credentials and the competence. So let's get into fixed income. Let's see if you can make it interesting.
Yeah, we may be continuing the somber tone here as we
grab your coffee.
So yeah, okay, well, let's just jump in then.
Okay.
Let's see, is my screen? There we go. So just a bit of what we'll cover today. We'll define fixed income. We'll talk about the role it plays in your investment portfolio. We'll talk about the features and mechanics of bonds, how they work, how they function. We'll talk about some of the risks investing in bonds. Or, it's a safer asset class certainly than equities, but there are risks. We'll walk through some examples of fixed income and give you some advice on how to invest in the bond market. And then, given this is a broader series that you all are a part of, and many of you may be considering or currently work with investment advisors, I'll try and share with you some of the pitfalls and things to look out for that may be of some concern. So as we jump in here, feel free, Pete, Don, send me over questions. I don't mind if you interrupt. We don't have to save them for the end, or you can, whatever you prefer, but I'll just get started. So what is fixed income? The overlap between fixed income and bonds is about 99%. So they're more or less synonymous, and they're used interchangeably with one another, those two terms. Essentially, it's a loan. So it's a loan to an institution, whether that be a government or a corporation, that is obligated to pay you back with interest at a pre-specified future date. So when we say pre-specified future date, that means the maturity of that bond is established upfront. So if you buy a 10-year U.S. Treasury bond, that is it's pre-specified that you will receive your original investment back in 10 years. You'll receive interest in the meantime, and then the U.S. government will pay you back. And that institution, again, can be a corporation, a municipality, a government, and so forth. We'll walk through some examples. So the owner of a bond is the creditor or the lender, and the issuer of the bond is the debtor. So very different than stock, right? When you buy stock, when you buy a share of Apple, you are a very small owner of Apple. So you're really betting on growth. In order for that stock to appreciate, typically there has to be growth in the company's earnings. When you buy a bond, you are lending money to that company. So the company doesn't have to grow, they just have to remain solvent and continue to pay their debts. So you can already start to see why it's considered a lower risk investment, right? Your company's revenues and earnings can decline, but still have the ability to pay your debt. So
let's go to the next slide. There you go.
You see? Okay, so I think there's just a slight lag. Role of fixed income in a portfolio, steady source of income, portfolio diversification, typically away from equities, which is typically the first investment most people make in their liquid investment portfolio. Hedge against stock market risk, as we'll see with some examples here. You have to know what sector of the bond market you're investing in, because some are negatively correlated, like U.S. Treasuries, with the stock market, and will go up oftentimes when the stock market goes down. But others are positively correlated. We'll talk about that with high yield bonds and so forth. So you have to know really where you are in the bond market and understand, is it negatively correlated with the stock market or positive?
Are you going to talk about why you should have a certain percentage of your assets in fixed income, even though the rate, the return is so low?
Well, these are all the reasons right here in front of you. Many of the reasons.
So your percentage, let's say if you had a 60% equity portfolio and a 40% fixed income, you're looking at that 40% of fixed income portfolio to give you the steady source of the income? Is that, and the portfolio diversification is so that if the stocks go down, your bonds hopefully will stay steady or go a little up?
Correct. Yeah. Principal protection reduces the volatility of the portfolio, which a lot of that comes down to psychology. We hear a lot of the clients who've joined our firm in the last 18 months or so. When COVID hit, they were very heavily invested in the stock market and they panicked in March and hit the sell button.
Yeah.
I would say the number one advantage, number one benefit of having fixed income in your portfolio is reducing the volatility such that when you get a bear market or a really meaningful market decline, you don't hit panic and hit the sell button because you just can't. You're sick to your stomach looking at your account when you
so you can keep the stocks that you have. You're not pushed to sell them.
Yeah, and particularly if you're in the distribution phase of your investment career where you're living off the income in your portfolio, this allows you. What we do typically at our firm is if we're in a rising stock market, we will take that distribution pro rata, meaning, if you're 60% stocks, 40% bonds, and you need a $5,000 distribution that month, we'll pull 3,000 from stocks and 2,000 from bonds. But if we're in a declining stock market, we'll pull the whole 5,000 from bonds so that we're not forced to sell stocks in the down market.
That's exactly where I wanted you to go, Kurt. Thank you for that, because in fixed income is just not giving you a lot of money. And so people wonder, well, why should I put my money in the bond area when stocks are doing so well? Let's go to the next slide.
Yeah, and one thing I'll just touch on here that's not always intuitive is the deflation hedge at the bottom there. Just conceptually, if interest rates decline and you're locked in at a given yield on your bond portfolio, that's a hedge against deflation, because when you have a deflationary environment, interest rates typically decline and your bonds that you're locked into at a higher yield will appreciate in value. Conversely, of course, if you enter an inflationary environment, it works against you, and bonds typically don't do so well in an inflationary environment. So key components of a bond: you have the issuer. Again, that's the institution. Who are you making the loan to? The coupon, which is not to be confused with the yield to maturity at the bottom. We'll walk through the key differences in those there. The coupon is fixed majority of the time. It's a fixed rate. When the bond is issued, it pays, say, a 4% coupon. The price of that bond will fluctuate, which is the third bullet there, based on what the market's doing and based on what it feels that that bond should be yielding. But that coupon stays fixed. So if you buy a bond that yields, there's bonds out there right now with a yield to maturity of 2% that are paying a coupon that's double digits because they were issued back in the 80s. Not that many of them left, but even bonds issued in the 90s were paying, healthy coupons when they were issued. They may have yielded 8% when they were first issued, but the bonds have since appreciated because we're in such a low interest rate environment now. And so now those bonds yield is much lower. And on a future slide, I'll talk about the mechanics of how that works.
How many bonds are there? Is the bond market bigger than the stock market?
Yes, by multiple. I don't have the exact numbers right now. It's been a while since I've had those numbers in front of me, but it's multiples bigger.
Okay.
Significantly bigger. Yeah, U.S. Treasuries alone, I mean, that's the most liquid asset class in the world, the largest. So outside of perhaps the Chinese property market. But so yeah, that bond market is massive, particularly when you talk globally. So the coupon, that's the coupon rate. Frequency is typically semi-annual. So if a bond pays 5%, it's typically 2.5% every 6 months. Maturity date, we've talked about that. It's closely linked to a concept called duration, which will determine your interest rate risk. We'll get into that. And then, of course, the yield to maturity. We can optionality call features. That's the ability of the issuer to call the bond at a specific date and essentially refinancing. You think about like your mortgage when you refinance. It's the issuer says, hey, I can pay a lower rate now. Either they want to pay down their debt or they want to refinance at a lower rate. They can pay it down. Two sources of total return in the bond market, just like the stock market. Most people are familiar with these concepts in the stock market. Your price return is what happens to the price of the stock over the time you hold it. And your income return is if that stock pays a dividend, that's income. In the bond market, same thing. The difference is the lion's share of the return comes from income, and price return. If you hold a bond, from the time it's issued to the time it matures, your price return is 0. But if you buy a bond that has risen in value, and you buy it at a premium above a price of 100, it always matures at 100. All bonds are issued at 100. They all mature at 100. So if you buy a bond at 105, over the life of that bond that you hold it, the price is actually going to decline 5%. So you need the income to be greater than that to get a positive total return. Conversely, if you buy a bond at a discount, say at 95, it's going to mature at 100. So long as they don't default and the loan is good, when you're paid off, that's a 5% gain you'll make on the price over the life of owning that bond, because you bought it at 95 and matures at 100. And then in addition, you'll receive an income return. The majority of the return in the fixed income world comes from income. These are, I'll talk about each of these, but credit risk and interest rate risk are the two biggest risks, and the ones that are easiest to identify if you're doing your own investing here in the bond market. So we'll go into some specific examples of those. But credit risk is the risk that the issuer pays you back, essentially that the loan is money good. Interest rate risk is the risk that interest rates rise. We talked about when interest rates decline, that's good for bonds. Interest rates and bond prices are inversely correlated, which means as interest rates rise, bond prices go down. And that's because you're locked into a given yield on your bond, say 3%. If interest rates rise to say 5%, your bond goes down in value because it needs to adjust to the current interest rate environment. So that's interest rate risk. Prepayment risk is the ability of the issuer to prepay the bond. And so you're locked into a nice yield. You really like your bond. And then, this happens a lot with mortgage-backed securities. Homeowners prepay their mortgage. So suddenly you're getting principal paid back to you early. And you say, hey, I wanted to own this bond for 20 years, but they're paying it down early. And suddenly I have reinvestment risk, which is now that they've paid off the bond early, what do I do with these proceeds? Where do I reinvest those? And can I reinvest them in a bond with the same yield that I had on my previous bond that was prepaid? So prepayment risk is the risk that the issuer prepays the loan. Reinvestment risk is that you won't be able to reinvest at the same rate. Currency risk is fairly straightforward when you're investing in foreign bonds. Inflation risk is tied to interest rate risk. When you have inflation in real dollars, net of inflation, returns on all asset classes are lower, whether it's stocks, bonds, what have you. But with bonds, typically having lower returns, that's a real risk. And we're feeling that right now, right? Right now, the investment grade bond index yields, sub 2%, and inflation is over 3%. So your real return on bonds is negative right now on investment grade bonds. So not a great environment for bond investors. So that's inflation risk. Liquidity risk is just the risk that certain types of bonds are less liquid than others.
So it sounds to me like this is like the professional race car driver. You don't want to do this on your own.
I would agree. In general, when you're investing in the stock market, it's about what you own. You can have a couple high flyers that carry the portfolio. When you're investing in bonds, it's about what you don't own. Yeah. Because if you think about it, if everything goes perfectly, all you get is your yield on the bond. But if something goes wrong in one bond, you can lose your entire principal, your entire investment. So it only takes one bond to take down your entire portfolio, even if you own, 15 bonds, individual bonds.
And the general public believes, I think, that the bond area is the safest place to be because it's actually more conservative and give you less income. It's literally, I think, 10 times more difficult to invest in the fixed income area than it is in the stock area.
It is. It's more work.
Very little return.
and it's for little return. I mean, to give you an idea, in a given year, if you take a look at two bond strategies or bond funds, their return can be less than 1% apart from one another, and one will be considered to have had a phenomenal year and the other a terrible year.
Yeah. Yeah. Okay.
Benchmark does 3%, and one of them does 3.5, and the other does 2.5.
Yeah.
That's night and day in the bond world. But for your overall portfolio,
Yeah.
it's not that big a deal.
Yeah. Let's go to the next slide.
Yeah. So, given all this talk of low interest rates, most people thinking about how do I increase my yield? There's really only two ways to do so. You extend maturity, which increases your duration and therefore your interest rate risk, right? Instead of buying a 5-year bond, you say, I'm going to buy a 30-year bond. And if you're loaning money for a longer period of time, naturally, you get a higher rate of return.
Or you should get a higher rate of return.
Unless you have an inverted yield curve.
Yeah.
We had no 5, which is rare. But yeah, you should have a higher rate of return the longer you loan the money. But that increases your interest rate risk. And if you think about it, if you own a bond that matures in 6 months and interest rates rise, it's not that big a deal, because in 6 months, your bond's going to mature and you now have the opportunity to reinvest at those higher rates.
In your firm, Kurt, what is your maximum duration today?
Well, on any given portion of the bond portfolio or the blended overall?
The blended. I mean, are you going out past 6 years or?
No, it tends to be it depends on the client situation. Our bond portfolio, our portfolios tend to be fairly tailored to the client situation, but in general, our blended duration is in the 5s. I mean, it's crept up. The lower interest rates go,
yeah,
if you hold the same bonds, your duration increases. So you have to actively manage that down.
Yeah. So you're in the 3 to 5 range for the bulk, but of course it all depends on the client situation.
Yeah, and we keep a lot on the short end as well. I mean, there's more than one way to arrive at a duration of 5. Right?
Yeah, we're going to talk a little bit about that as you move on. So
sure. And so just to finish that, if you have a bond that matures in 6 months, it's not that big a deal if interest rates rise, because in 6 months, you have the opportunity to reinvest at those higher interest rates. Therefore, that's why a 6-month bond has a very low duration and very low interest rate risk. If your money's locked up for 30 years in a bond with a low yield and interest rates rise, that bond gets hit really hard. It has a high duration and high interest rate risk because you're locked in for 30 years. So you can't take advantage of higher rates until that point in time.
Yeah, I haven't heard one financial advisor on the program during the It's Your Money series extend out from 6 years maturity or duration. So yeah, where do
they won't admit to it?
So if you own a bond, are you going to talk about bond funds?
Oh yeah, there's a lot.
Okay. Well, I'll hold off my question until a little later.
Secondly, you can go dip down in credit quality, right? You're now making loans to riskier borrowers, and that will increase your credit risk, increase the risk that the person doesn't pay you back, your default risk, but will also naturally increase yield as well. So example 1, extending maturity. These are 2 bonds from the same issuer, JP Morgan. They both pay the same coupon. But again, coupon is not what's important here. That's the yield when they first issued the bond. We're well into the issuance, past the issuance now. The price is no longer 100, which it's issued at. You see the prices have moved. And really what's important here are the yields. This is if you buy this bond, the yield you get until it matures. And as you see, if you buy this bond that matures in just over a year, here's your yield, sub 2%. If you buy this bond that matures all the way in 2046, you're at 3 3/4. So all else constant, same issuer, same credit quality, same coupon. The longer the maturity, the higher the yield, and the greater your interest rate risk.
So the YTM stands for yield to maturity?
Correct, yield to maturity.
And then, and so when a bond goes down in value, does that mean your interest percentage that you were receiving changes, or does that stay the same?
When the bond price decreases?
Yes.
If you hold that bond, your interest you receive stays the same.
Same. Okay.
Yes. But if someone else were to come in and buy that bond, their yield to maturity would now be higher, because not only would they receive that interest you're receiving, they're now buying at a lower price.
Correct.
Kurt, we seem to have a black box over your image.
Well, I'm going to share
there you go.
a video real quickly.
Thank you.
And let's So this will just talk about interest rate risk here. Quick explanation.
Remember that the value of bonds can fluctuate up and down based on factors such as the movement of interest rates. This is called interest rate risk and warrants some discussion. Interest rate risk affects all bonds, regardless of their credit quality. Let's say you buy a $10,000 bond with a 10% interest rate that pays you $1,000 each year until maturity. Can you sell your bond before its maturity to another investor for the $10,000 you paid for it? Not always. Why? Because you really don't own a $10,000 bond as much as you own a security that pays you $1,000 of interest a year. The annual interest payment and current interest rates on any given day in large part determines what the bond is worth. We're going to oversimplify the pricing of bonds to illustrate how prevailing interest rates determine the price of your bond day to day. Assume that after you buy this $10,000 bond, interest rates drop from 10% to 8%. Not to worry though, your investment was locked in at 10%, so you'll still earn an annual $1,000. But let's say another investor wanted to buy a bond that would also earn them $1,000 annually. How much money would they have to invest at the new interest rate of 8%? $12,500. That means that your $10,000 bond could be worth $12,500 if you chose to sell it, a $2,500 gain. But what if interest rates increase to 12%? How much money will a new investor have to invest at 12% to earn $1,000 annually? $8,333. Now your $10,000 bond is worth almost $1,700 less than you paid for it. Think of a teeter-totter. Sitting on one side of the teeter-totter is interest rates. On the other side is the value of bonds. As interest rates go up, the value of bonds go down. As interest rates go down, the value of bonds go up. You can buy bonds of various maturities. The longer the maturity, the greater the interest rate risk. Think again of the teeter-totter. The closer you are to the middle, the less movement up and down as the teeter-totter swings. The distance from the middle is like the maturities of bonds. Short-term bonds don't fluctuate as much in price given interest rate changes. The longer the maturity of a bond, the greater the fluctuation in price. But what if you don't plan on selling your bond before it becomes due? The day-to-day movement in the price of bonds may be of little concern to the investor who buys an individual bond and holds it to maturity. At maturity, the investor receives the face value of the bond, $10,000 in our example, and has received interest payments in the interim. His bond was protected from the interest rate risk inherent in the market.
Let's see here. Can you guys see my screen again?
Yeah,
Okay.
we got it. You're back.
All right. So hopefully that summed up interest rate risk. I'll give you the quick calculation to give you an idea. If you have a bond with a duration of 5, and you can do this with a bond fund, you can go into Morningstar and you can look at what's the duration on this bond fund. So if the bond fund has a duration of 5, let's say it has a yield to maturity of 3.5%. If interest rates rise 1% over, we always say over a 12-month period. I mean, that doesn't really happen in a day, right? Over time, interest rates could rise or fall. If interest rates rise 1%, here's the calculation. It's the change in rates, negative, times the duration. That's your change in the price of your bond fund or your bond. So since interest rates moved 1% higher, it's negative 1% times 5. So you lose 5% on the price. Interest rates move up 1%, you have a duration of 5, you lose 5% on the price of the bond. Return over 1 year is going to be that same calculation, negative R times duration, plus whatever the yield is you earned while holding that bond, right? You're still getting your interest payments. So you lost 5% on the price of the bond, but you made 3.5% in this example in yield. So price, again, price return, income return. Income return is 3.5%. Price return is -5. Your total return is -1.5%. Same example, except interest rates fall 1%. Same bond fund, duration of 5, yield to maturity of 3.5. Now price is moving in your favor because interest rates have declined, right? This is a deflation hedge. 1% times 5, you get a 5% price gain in your bond fund. Plus your total return is you add in the yield, the income return of 3.5%, just as we had before, Now your total return's 8.5%. So that's how, you see, as you see in this example, the price return was either -5 or +5. Totally overwhelming this 3.5% income return. That's what you get in a low interest rate environment, is the price of your bond can move more than the actual income that's being generated over the course of a year.
So can anyone predict interest rates, whether they're going to rise or fall? I mean, you've got,
not that I've seen. If you look at it's interesting. I mean, if you look at the expert forecasters, where they predict rates will go, you'd think it would be kind of half of them predict too high and half too low. Routinely, over 70% get the direction wrong. Where interest rate's going to be in a year, 70% of experts get the direction wrong. So
then those are the experts.
Those are the experts. Yeah.
So that's why you can't really predict which way it goes. And that's why you kind of stay short if the trend seems to be going up.
Particularly, yeah. And if the yield curve's flat, the flatter the yield curve, the shorter you want to be.
Do you have a slide on the yield curve? I don't know if you.
No, I don't. Okay.
Explain what a yield curve means.
Yeah. So think of an X and Y axis, right? And on the horizontal axis, you're looking at maturities, the X axis. So you've got a 6-month, a 1 year, a 10-year, all the way out to 30 years, right? So that's the maturity. And then on the Y axis, vertical, is the yield. So it's basically saying, what does the yield on a 30-year bond look relative to the yield on a 10-year bond and a 2-year bond? And how does that change? So when you have a flat yield curve, the yield on a 10-year bond is not that much more than the yield on a 2-year bond. So do you really want to go out 10 years and take on that interest rate risk when you're not going to get that much more yield for doing so? You're not really compensated for doing so? Probably not. You'd probably rather stay short, get the same level of yield, and wait for another time when interest rates rise. If you have a steep,
so right now we're in a flat yield curve.
Yeah, it's pretty flat. Yeah.
Okay.
You have a steep yield curve though, like we had in 2018. You want to extend duration because you want to get out there and extend your maturities because you're well compensated for doing so.
Let's go to the next slide.
Yeah. So example 2, credit quality. So you see here, these are 2 bonds. You can really see 2 things here, actually. One, you can see that, this is Citigroup and Verizon. Verizon, lower credit rating, right? BBB. So the credit ratings, the way they go is the highest quality is AAA, then AA, single A, BBB, double B, single B. And then you have the same with C, triple C, double C, and then eventually you get to non-rated. So an A- credit rating for Citigroup is higher than Verizon. And so these bonds, same maturity, slightly different coupon, but Verizon has a higher yield, right? It's lower credit quality, but it has a higher yield. So that shows you the concept that lower credit quality gives you a higher yield. Another thing you can see here is this Verizon bond has a higher yield despite the fact that the coupon is actually lower than Citigroup's coupon. So the interest payments are lower. So how can you be receiving lower interest payments but have a higher yield to maturity? Well, you must be paying a lower price for the bond, right? So whoever buys this Verizon bond at 99.5, they're going to get a positive price return because this thing will mature at 100. Whoever buys this bond from Citigroup at the Citigroup bond at 104 is going to have a negative price return because their bond's going to also mature at 100. So you're baking in a price loss with that Citigroup bond. So that's how, go ahead.
But will a mutual fund give you this kind of information, what the credit rating is from the manager that kind of bonds they invest in? Will they give you the yield to maturity that they're looking for?
If you go to Morningstar, it's a great tool. And if you click on portfolio, they will show you the average credit quality, which I don't think is as informative as the various tranches. They'll show you what percentage of the portfolio is AAA, AA, single B, triple B, and so forth. And so you want to see, how much are they allocating to those junkier areas?
Does it, when you go BBB and below, that's below investment grade, is that correct?
No, BBB is the threshold for investment grade.
Threshold. Yeah, does that mean that it's a bad investment?
No, you just want to know where it is in your portfolio. The lower in credit quality you go, the more positively correlated that bond is going to be with the stock market, because it's going to be junkier. It's going to be lower credit quality. You just want to be appropriately compensated for it.
Okay.
Taking that risk. Okay, so all is constant, lower credit quality equals higher yield. All right, so let's go through some examples of fixed income. Cash and cash equivalents, typically anything that matures in less than a year. So you may think about CDs in the bank, money market funds, treasury bills, all of these pay, what they have in common is they all basically pay nothing right now. And then what we would call bonds, you have US government bonds, those would be treasuries, mortgage-backed and asset-backed. That's where they're pooling all of our individual mortgages together and issuing a bond based on the stream of payments that we pay each month.
Hang on a second, Kurt. On US government bonds, why is it important for the lay person to know what they're paying?
To know what the interest rate is?
Yeah.
So that's considered the risk-free rate. And so a lot of the economy and financial modeling is based off of that. Mortgage rates are tied to the 10-year US Treasury rate. That's considered the risk-free rate because the basic assumption is that the US government is money good and that there's no credit risk there. That's a topic for another discussion, given
but in the world today, every country, every financial practically institution considers the US government the risk-free rate.
Right. And because of that, there's a term called spread, credit spread. And so when you think about bonds, bond managers, they don't think about, oh, what does this corporate bond yield in absolute terms? They think about spread. So they say, what does this yield above US Treasuries? What does this yield above the risk-free rate? That's what I'm being compensated.
Yeah, that's exactly why it's important to know, because if somebody offers you a 9% return, today, that's quite a spread.
It is. Exactly.
You should have extreme caution.
Right. Asset-backed, that tends to be similar to mortgages where they pool them. That's typically student loans or credit cards, sometimes auto loans.
Are you investing in any mortgage-backed and asset-backed security?
That's the one area, and I have a slide on this. That's the one area where in this space where we typically would go with a fund here. I mean, we do a lot of individual bonds in-house, and I'll explain why. I don't recommend that for the folks, for people who are not professionals and doing it for a living, because it's very difficult if you don't have the transparency on pricing. But even the mortgage-backed space, we go with a fund. It's very esoteric, and anyone who saw The Big Short can, unless you're Michael Burry, it's tough to you really have to dig into the weeds to understand the different tranches and how those bonds are chopped up. So you want to go with a specialist in that area.
And if you go for a specialist in that area, what kind of percentage of your fixed income portfolio should that be? 30, 40, 50%, 5%?
It changes over time. No, between there. So typical total return bond fund is around a third treasuries, a third mortgage back, a third corporate.
Okay.
And then, to the extent that bond fund is, some will bring in high yield, some will not. So it may go down from there, but typically you're going to see in mortgage backs and a diversified portfolio, you're going to see somewhere between 20 and 35%.
Okay. And so you need to know from your client how much they're spending on an annual basis. So in the event they need to tap in to their bond portfolio for that income.
Absolutely.
Yeah.
Absolutely.
So, and that will then determine how that bond portfolio will be set up, because you may need the money
and the percentage of their portfolio that's allocated to bonds. We like to know more than just their spend rate. We like to know their income, what's their income tax rate, because that will dictate, are we going into municipals? Preferred stocks can provide solid income with qualified gains, qualified dividends. They're taxed at the long-term capital gains tax rate. For high income earners, those make a lot of sense.
And the corporate bonds should make up the bulk of the bond income.
It depends. These days, yes, because treasuries the yield on treasuries is so low. And mortgage backed, by the way, there's agency backed and non-agency. Non-agency will yield a lot more because agency backed, I mean, they're backed by Fannie Mae, Freddie Mac, Ginnie Mae. Those are basically, they trade pretty close to treasuries because it's widely accepted that the US government will step in and bail them out if they get into trouble.
Right. So they're not paying a lot either. So,
no.
so your focus today is on corporate bonds and municipal bonds.
In our portfolios, we have a lot of corporates, a lot of municipals.
Yeah.
Yes.
When should somebody, we'll talk a little bit about the high yield junk part of your portfolio. Do you have, give us a kind of a safe percentage for most folks?
So for most folks, a safe percentage in high yield bonds is probably around, you don't want to really go above 15%.
Okay.
Depends. It's fluid for us because we track the yields and the relative spreads so much that we know when they're trading richly and when they're cheap. And so we'll dial that up and down.
Okay.
That's
So, and then municipal bonds are tax-free. But again, when do you start looking at a client's portfolio for municipal bonds?
For a single filer, 200K in income, but for a married couple, it's around 400K. You know, once you factor in, in California, a married couple earning 400,000. Once you factor in, deductions and deferring to their 401K and all that type of stuff, that gets you in the 300s, which is around where you're jumping up in your income tax rate into the 30s.
So somebody shouldn't be buying municipal bond funds just because it's tax-free.
No, we see that all the time where clients come in and they have low income and they've got these muni bond portfolios, and not paying income tax on your sounds sexy, but there's a calculation called taxable equivalent yield, and the reality is, unless you're in the top tax bracket, you're better off buying a bond with a higher yield and paying the tax than buying low. I mean, muni bonds right now, safe muni bonds, you're happy if you're getting 1.5%.
Yeah.
So it's a really low yield. That's what you call an implicit tax. So,
yeah, I see municipal bond funds sometimes in people's IRA accounts. Why would you do that?
Well, you shouldn't. You buy those in taxable accounts because they're tax-free. You're already inside a tax-sheltered environment inside of an IRA or a Roth IRA. So you want to be buying taxable bonds with higher yields in those accounts.
Talk a little bit about TIPS and the international.
Yeah, TIPS are Treasury inflation protected bonds. So the actual coupon payments is one of the few areas in which the coupon payments will fluctuate. As inflation goes up, the payments will go up. So if you're in a high inflation environment, they can do well. The issue is, and so I'm sure many are thinking, well, that's where we are right now, so maybe I should buy a bunch of TIPS. This asset class has chronically underperformed for decades because what has to happen is all of that's priced in. Anything about inflation right now, the market knows and has priced that into TIPS. So such that they trade at a level where the yield is not any better than treasuries. And so to the extent that inflation exceeds the market's expectations, you'll do well in TIPS. But if it fails to meet the market's expectations, you actually do pretty poorly. And that's happened now for a couple decades.
So what I'm hearing from you is you're not buying any TIPS today.
No.
Okay. How about the international emerging market bonds?
Yeah. We don't do as much in that space. Emerging market bonds get, typically higher yields. International, if you're going to developed, international non-US is broken up into, typically when people say international, they're not referring to emerging market. They're referring to developed international, which means like Europe, Canada, Australia, so forth. They oftentimes pay, if they're government bonds, they pay lower yields than the US because they have lower growth rates in those countries. So the bond market reflects that. Emerging market bonds, however, can pay much more. They tend to be more positively correlated with the global economy, however. So you're getting, higher yields. It's kind of like high yield bonds, junk bonds, where you're getting higher yields, but there's perceived to be higher risk, and there's more positive correlation with the stock market. So they'll likely lose value when the stock market declines.
So are you investing in your clients' money into any emerging market bond funds?
Not at this time, no.
Not at this time. Okay. Zero coupon, you mostly for insurance companies, I presume?
Yeah, those have the highest interest rate risk. You buy them at a discount. So all of your return is based on, you buy at a discount, there's no coupon payments. And then you get, imagine you buy a bond, a zero coupon bond for 95, it matures at 100. And that's how you make your 5% over, whatever that maturity may be, that time period, but they don't pay any coupons. And because of that, they have, relatively high interest rate risk relative to, say, an equal maturity bond that does pay coupons, because when you get that coupon money back, you can reinvest that at higher rates. You're not getting a coupon, so you're stuck in those bonds.
Let's go to the next slide.
Yeah. So a couple, things, a couple of pieces of advice. Treasury bonds. This is the most liquid security in the world, considered to be credit risk-free. You can actually buy these directly if you wish. ETFs are a great solution for treasury bonds. If you're going to segment, my recommendation on the whole, and I'll get to this later on, but basically is, if you're going to do it yourself, either buy bond funds or, mutual fund, diversified bond mutual fund, total return fund, or one thing you can do is segment the treasuries out and buy an ETF, because the a bond fund, if it's an actively managed bond fund, will cost probably 40 basis points. A treasury bond ETF, where they're not really adding any value, it could be a third of the portfolio of that diversified bond fund. So why pay 40 basis points? You can go buy an ETF for 5 basis points. And then that just means to get your corporate bond and mortgage-backed exposure, you go buy a focused bond fund that only does corporates or only does mortgage-backed.
When you're investing in bond funds, expense ratio is just huge.
Yeah, it's one of the big reasons why we do individual bonds here is, oftentimes the fee on the bond fund in this interest rate environment is a third of the yield.
Yeah. Well, you're one of the few financial advisors out there that'll buy individual bonds.
Right. And to be clear, junk bonds, high yield bonds, and mortgage backed, we still buy bond funds. Treasuries will do an ETF. It's only corporates and muni, only high investment grade corporates and municipal bonds that we buy individual bonds for clients who have a sizable enough portfolio that we can get that diversification. So for clients,
talk a little bit more how important that is, diversification in this area.
Yeah, well, if you think about it, if you need, how many bonds do you need to feel diversified, right? So let's say you need at least 10, sometimes you need 20, right? Let's say you 10 bonds to be diversified. And if you need to invest at least 25,000 in each, so that, they're not what we call odd lots, which can be less liquid when you go to sell, that's 250,000 you need to allocate right there to just, say, your corporate bond portfolio, which probably implies your total bond portfolio might be worth $500,000. And if your total bond portfolio is $500,000, your total portfolio with equities is probably more like $1 million. So you need to have a sizable enough account to be able to justify buying.
I thought that you just would, if you bought a bond at 25,000, you're going to get nailed, because that's such a small amount that you had to go up at least 100,000. But that's not the case.
Less so these days. You can trade smaller lots more easily than you used to be able to. Yeah, if this were, 7 years ago when we were talking, I'd say, you don't want any bond less than $50,000.
But I don't think the regular consumer can outperform a professional in this area.
And a professional that's going to outperform?
Yeah. Well, I mean, a regular consumer outperformed a professional. I don't think that's
because the pricing you get is really poor compared to what professionals.
Yeah. So if you're looking at individual bonds, please get out of the way.
You don't have a dealer network. If you're looking at individual bonds, you're probably looking at Fidelity or Schwab's inventory, which is, those are just money printing centers for them. They just print money. What they do is they go, and you can see this. I've got a link here later where you can see past bond transactions. They'll go buy a bond at 99 and then they'll turn around and sell it to you for 102. And not even the next day, they'll sell it to you an hour later at 102. And they just made, boom, 3% in an hour holding this bond because you're a price taker. You go in there and you see that bond, you say, oh, this yield's acceptable to me. And you don't have a dealer network. we have a network that we go out to when we trade bonds. So we're
Yeah.
getting bids from all sorts of dealers. So we have transparency into pricing.
You-
It's unlike, Apple stock, everyone knows what that trades at on their phone, right? Whatever Apple stock's trading at $1,000, you're not going to go buy Apple stock at $1,500 a share if you know on your iPhone it's telling you it trades at 1,000. That would never happen because they trade on an exchange. It doesn't happen that way in the bond market.
You mentioned an ETF for treasuries. ETF stands for exchange traded funds.
Yeah.
Would you recommend any other ETFs in the bond area?
Well, so I would avoid them for muni bonds and high yield bonds.
Yes.
ETFs are basically, they're as good as the liquidity in that space. So treasuries, they're great. The one issue with ETFs is a lot of them tend to be passive. And I know you guys have gone through, the stock market portion of this series, passive investing. There's a compelling argument for investing at least certain portions of your equity portfolio passively, very low cost, areas where the market's really efficient, and studies show that active managers do not outperform over the long term, and the ones that do tend to change each year. So, for instance, in the equity portion of our portfolios, we have passive exposure in various areas of the market, not always market cap weighted, but we have a large swath of passive exposure that's complemented with some active. In the bond market, you're better off going active. The majority of bond managers, particularly the ones who are, household names that you would go with, they do outperform the index. Two things with the index. One is the bond managers, they created this index. It contains no high yield, no what we call spread products. So it's all really high quality, and therefore the yields are really low. So that's why managers routinely outperform the index. Number two, think about how an index is constructed. So with stocks, the S&P 500, if you go by SPY, it's not, if you allocated, $500 to SPY, you're not allocating $1 to every company. 20% of your dollars, $100 is going to Apple, the FANG stocks, Apple, Google, Facebook, and so forth, or excuse me, Meta. And the reason for that is they weight it based on market cap. So the biggest companies in the S&P 500 get the biggest weighting. Well, there's some risk with that, but at the same time, there's also some logic there, right? If this is the biggest company, they're going
to do better.
Yeah, they have a competitive advantage. Maybe there's a moat, all these types of things. You can justify that they'll continue to do better. In the bond market, how is a bond index constructed? The most heavily weighted issuer is the person with the largest outstanding debt. So the biggest debtor is the biggest position, which is counterintuitive. Do you want to go lend money to the person who has the most debt outstanding, or do you want to lend it to the person who has the least?
Oh, that doesn't make much sense.
Right. And there's one other thing, and this is why passive bond indices routinely underperform active. When these indices are, I just lost my train of thought. I'm going to come back to that one.
Okay.
So the largest debtors are the largest position in those bond funds. Here's the other piece. If you don't have active credit risk management going on in your bond fund or your bond portfolio, remember what I said earlier. In the bond market, it's about what you don't own. So when you buy a bond index, you own everything. And all it takes is for a few of those to default, and you lose everything on those. You're only earning a small yield on the rest, and those defaults can really impact your return in a negative way. If you have an overlay of active credit risk management from BlackRock or PIMCO, they're able to weed out the weakest issuers, right? The most likely to default. And by doing that, they have less defaults in the portfolio, and you're gonna have a better return. So bonds are about what you don't own. So if they can just weed out the weakest, 5% of the bond market, you're gonna be much better off. So
if a consumer wants to invest on their own in the bond market, would you recommend Vanguard?
It depends. So Vanguard, believe it or not, Vanguard has some active bond funds.
That's what I mean.
They're the passive household name, but that's really more on the equity side. Even Vanguard recognizes on the bond side, you want to have someone behind the wheel.
Yeah, and then any other mutual fund families that you would recommend as far as somebody who wants to invest in the bond market?
Yeah, if you're going broadly diverse, BlackRock's great, PIMCO's great. Those are the two biggest bond managers.
Just make sure you buy the no loads.
Oh, absolutely.
Yeah.
Yeah. A
Yeah.
load on a bond fund. I mean,
Well, Franklin Templeton is an example of a load fixed income fund. And it's silly because your load out, it'll take you many years to get back.
And this
Just your
interest rate environment
commission
could
on
take
that.
you a decade to get
Yeah,
back.
let's go to the next slide.
Yeah, so this is just segmenting investment grade versus high yield. Know that high yield is a higher correlation to the stock market. It's more credit risk. In investment grade bonds, even though they're lower credit risk, they have higher interest rate risk.
And just as a note, we're under 20 minutes to go and about halfway through. So,
okay, I'll get ripping here. So
I'll stop interrupting you.
thank you, Pete.
mortgage backed. We talked about this. They're backed by pools of mortgages. Know if you're buying a mortgage backed fund, see what percentage is agency backed versus non-agency. Agency backed are very safe. Non-agency are riskier, but they're higher yielding. So you want a quality manager that knows how to do that. Recommend an active fund here. Municipal bonds, again, the interest income's tax-free. If you're a California resident, you want to buy California domiciled issuers. Not too difficult. 20% of the muni bond market's California. As Pete mentioned, only buy these in taxable accounts. I would recommend sticking to, if you're going to buy individual bonds, stick to GOs, general obligation, and essential service revenue. They tend to be safer. And just know that credit ratings here are much less reliable than the corporate bond market. They're only issued in arrears annually, as opposed to corporations which issue quarterly. And pay attention to the yield to call. Muni bonds are typically callable. So that's important. So how do you get into the bond market? You can buy individual bonds. The benefits are you can hold them to maturity. You will, as long as they don't default, you will get your principal back plus interest. You can avoid the fees that come with a bond fund, which, you know, in this interest rate environment can be a third of the overall yield. That's why we buy a lot of individual bonds here at our firm. The drawbacks are the pricing is, you know, we have opaque pricing here. That's what we talked about earlier. It's, if you don't have a dealer network, it's really difficult to understand if you're getting a good price or not. The credit research process is intensive, and it's also, as we mentioned, you need to have a sizable allocation to this portion of your portfolio to, you know, achieve appropriate diversification. If you're buying individual bonds, my recommendations are, you know, watch out for they're always going to say, oh, there's no commission, and there aren't commissions. There's no transaction costs. The costs are built into the price you're getting. Like I mentioned, with Fidelity buying at 99 and selling to you at 102, that's the commission right there, the spread. You want to avoid, you know, buying odd lots, you know, less than $25,000 pieces. And you can look at past transactions at this link, and you'll see the same bond trade at, you know, a yield to maturity of 2 and 4 on the same day, which is a massive difference. And the person who's buying it at 2 is usually an individual, and the person buying it at 4 is an institution. Mutual funds and ETFs. You know, this is probably the easiest place to go. You have smaller dollar amounts. You can get a lot of diversification. They're very liquid. You know, 2 approaches I'd recommend: just go buy a total return bond fund, or a slightly savvier way, if you want to do a little bit more work, is use a treasury ETF for your treasury exposure, which would be very low cost, and then go buy a corporate bond fund and a mortgage-backed bond fund. That's another way to do it. That way you're only paying that active management fee on the corporate and the mortgage-backed portion, and buy them roughly equal amounts.
And Morningstar will give you the expense ratio for these funds.
It will. Typical interest rate environment, I'll tell you, go a third treasuries, third corporates, third mortgages, keep it easy. In this environment, I wouldn't put a third into treasuries. I mean, they're yielding nothing. It's basically, we call it return-free risk. A lot of interest rate risk, and you're not really getting any return. So you want to heavily. If
you need the money in 6 months, maybe you want to put it into treasuries. You know you're not going to lose money.
Yeah. So long as it's a short duration bond.
Yeah.
Yeah. Because you don't have any interest rate risk then. The drawbacks with a bond fund, just understand that there's no guaranteed return of principal. If you hit an environment where, you know, you think back to the taper tantrum in 2013, where interest rate spikes and your fellow investors in the that you are tied to in the bond fund, if they all hit the sell button, that bond manager has to sell those bonds just at the point when you don't want to be, when they're depressed in price. And then you're baking in losses. You don't have that problem with individual bonds. You don't have to worry about the day-to-day mark-to-market bond prices. You can just hold them to maturity, and the prices will recover because they mature at par or 100. And then again, we mentioned passive funds overweighting the largest debtors, so watch out for that. With mutual fund recommendations, like Pete said, no load, no 12B1 fees. You can buy the institutional share class. That'll be the cheapest share class. You want to avoid the more expensive share classes. Know the manager, and don't chase recent past performance. You want to stay away from, unlike equities where you say, hey, maybe this person's a really good manager. They've had strong historical returns. With bonds, if somebody had a double-digit return last year with interest rates as low as they are, that tells you that the majority of that return came from price return, not income return. So what do you have to have huge price return? You have to have bonds that appreciate significantly in value. All those bonds mature at par. So what does that mean? It means all that appreciation eventually is going to unwind as those bonds amortize to par. So future performance is negatively correlated with past performance in the bond market. Because if you take a look at, if you order all the bond funds in with their past year's return, all the ones that are high single digits, double digits, they're most likely going to underperform next year. That's just how it goes. So go for the manager, the quality of the manager, not past performance. That makes sense.
Yes.
ETFs, again, understand, you're going active or passive. There's a lot of active ETFs now too. I hammered on passive ETFs there for a minute, but understand there's a lot of active there as well. They can be low cost. And then you want to avoid them in the less liquid sectors of the market, high yield munis. So fixed income today, this chart is sobering, right? What this shows you is if you take a look at the current yield on a bond index or bond fund, the 5-year return going forward on that bond fund, bond index has a 94% correlation to the starting yield. What is the current yield? Right now, that current yield is about 1.6. There's a 94% correlation. Why is that? That's because that yield is your income return. And we talked about there's price return, but the reality is if you have a laddered bond portfolio, if interest rates rise, you have bonds that are maturing. So if interest rates rise, the value of your bond portfolio goes down today, but your bonds that mature reinvest at higher rates going forward. And that has an offsetting effect. The reverse is also true. Interest rates decline. That means the value of your bond portfolio is increased in value, but as your bonds mature, you're now forced to reinvest at lower rates of return, and that has an offsetting effect. So that is why the correlation on a 5-year go forward rate, the correlation between what your return is going to be and what the starting yield is 94%. It's a really high correlation. So that tells you not to expect much more than this in your bond portfolio going forward. And this is an investment grade index. So temper your expectations. And then what else can you do? Alternative sources of yield. For high income earners and taxable accounts, we like preferred stocks that pay qualified dividends that are taxed at the capital gains tax rate. We're finding these in that 4.5% to 5% range. Those are qualified dividends. So those are nice after tax. The problem is you can't go buy a preferred stock fund and get that, because if you buy a preferred stock fund, the majority of the dividends are not qualified. The ones we buy are qualified, but that's a way that you can add some yield to your portfolio. Dividend paying stocks, of course, I'd probably stay away from floating rate bank loans. They have short duration, low interest rate risk, but really high credit risk. They're very similar to junk bonds with their credit risk. Most of you have probably heard of REITs. There's publicly traded and non-public. Publicly traded REITs they're expensive right now. Everyone thinks real estate will do well because it did the last time we were in an inflationary environment, and it's a hard asset. But if you go look at REITs right now, they're trading at way higher valuations than they were the last time we had inflation. So I'm not so sure.
Kurt, I'm going to stop you just for a second. It seems like there's a black on your slide on the top.
Oh.
I think it's because of the share screen from
Yeah.
your other,
Let me do this.
yeah, now it's down in the middle.
You still see it?
Yeah, but it's, now it's at kind of
Let me
3/4 on the way down.
Let me stop and then just reshare.
Okay, sounds good.
Sorry about that.
Thank you folks for letting me know.
Still see it?
Yeah,
Yeah, okay, let me do the.
now it's on 2 spots. One is on top and one is in the middle.
And incidentally, as a note, having watched those go through, please download the material off of the website. And so then you can pick up what those titles are, because whatever reason, this is tracking around with us here.
You still see it?
Oh, yeah.
That's so odd.
Now there's 3 of them. Now there's 1. Wait,
Oh, you
go
almost
back to
had it.
that, Kurt.
Okay. I can share, let's see, I'll share this one.
If you okay, that one now isn't doing it. I was gonna say, because if you, for some reason, there's 3.
It's gone.
Now there's 2.
No,
No,
now
no,
it's on
didn't-
top.
How strange. You still see it?
Yeah, it's on
What if I-
top.
Okay.
Anyway, download the material afterwards and you can find out what he was talking about on the titles.
Yeah. Now it's on the bottom and on, now you got a box on there. I don't know what's happening.
That's so odd. I don't know.
Yeah, we'll leave it where it is right now because
Okay.
it's out of the slide.
Okay, well, let me get through some of this. So
Yeah.
master limited partnerships, there's some complicated tax associated with those. So you want to talk to your CPA before doing anything there. They tend to have higher yields. They tend to often be associated with energy. They tend to be risky. Closed-end funds, watch out for those. Closed-end mutual funds, you'll recognize them because they usually have 3-letter tickers. They offer higher yields that are attractive. It can be high single digit, but it's because they use a lot of leverage. So, know what you're buying there. Private lending, you can get much higher yields. Those tend to be real estate backed private lending funds. You need to be a qualified investor for those. You are typically not custodying your assets with a brokerage firm like Vanguard or Fidelity or Schwab. You're actually wiring money or writing a check to somebody who's taking custody. So, you need to make sure you're not going into, you trust the operator who's running.
Yeah, but any of these, please don't go to a broker. You need a fee-only fiduciary registered investment advisor if you're going to go into any of these.
Right.
You're so much better off keeping it simple, stupid. Stick with a PIMCO, stick with a Vanguard, BlackRock, and do what Kurt had previously said. These are for the professionals.
I would agree. Yeah, we do some stuff in the private lending space for our high net worth clients. But again, if you're doing this on your own, I would stick to,
Yeah, an accredited investor, just what I call, I could sell you anything.
Right.
So don't become an accredited investor.
Okay, so portfolio recommendations, focus on tax efficiency. Don't own munis in your retirement accounts. Only own them in taxable accounts if your income justifies it. Keep an eye on costs always. Be aware of the interest rate risk and the credit risk in your portfolio. What is the duration and the credit quality of the securities you're selecting? Of course, diversify. And if you're buying individual bonds, ladder those maturities.
Yes, stay away from individual bonds.
So, this is how we think about it. When we think about tax optimization of a portfolio, we're putting, tax inefficient assets in a retirement account, and then we're putting tax efficient assets in a taxable account. So the munis would go on the right-hand side, corporate bonds would go on the left-hand side, preferred stocks on the right-hand side, and high yield bonds on the left-hand side. Now, I just take a step back here. We've talked a lot about bonds. I think it's important to understand that, like we said, the returns in bonds are really low right now. And really big picture, the biggest determinant of your returns over time are going to be 2 things. 1, what percentage do you allocate to the stock market? And 2, it's not whether you buy mutual funds, ETFs, or individual securities, whether you do it yourself or have an advisor, growth or value. It's, do you sell at the wrong time, right? And here's some examples. And I don't know, I think my screen's covering it, but
yeah, just right at the bottom.
I don't know what that did, but Maybe
No, it's gone. Now it's going to the
Hey,
top.
who knows? March 2020, March 2009, March 03, October 87. It's really hard for your portfolio to, it takes a long time for your portfolio to recover if you hit sell here. And the biggest thing bonds can do for you is help you manage your emotions during a bear market such that you do not sell your stocks at the bottom. You know, in this interest rate environment, that's the biggest favor bonds will do for you.
Yeah. Especially if you're not working and you're just depending on your income from your portfolio.
Exactly. So here's some other recommendations. You know, always look at your results net of fees. If you're working with an advisor, think about your after-tax results, not your pre-tax and after-tax return, or can be quite different in taxable accounts. You want to compare your results to a benchmark and, you know, evaluate them over a reasonable time frame, you know, 3 to 5 years, most likely. This is not, there we go. So I said I'd reveal some, you know, some things about our industry, things to keep an eye out for if you're working with an advisor. If your portfolios in your trust or individual account and your IRA look identical to one another and hold the exact same securities, that's a red flag that they're not managing in those two environments in different ways, because you should be. Failing to manage your taxable account in line with your tax bracket. If you're a low income earner, you shouldn't have munis in your taxable account. Buying high cost mutual funds, which of course add layers of fees on top of their fees. It's one thing for you to buy a mutual fund where that's all you pay. But if you go hire an advisor and then they're buying expensive mutual funds, now you're paying their fee plus that mutual fund fee. And that can be difficult to overcome in the long run. So if they're not offering, you know, in-house strategies, you know, where they can remove that layer fee, that's a red flag. Charging fees for financial planning. You know, there's enough advisors that don't do that you can get around that. And if there were, you know, keep an eye out for your investment returns. Are they being reported to you net of fees or before fees? And, you know, hopefully your portfolio is personalized to your specific situation. Lastly, I'll just tell you, you know, this is what we do. This is how we think about portfolios. So I'll pull this up here. So these are our clients. And as Pete mentioned at the bottom, you know, we're fiduciaries. We invest all our personal assets and our family's money in the exact same securities that our clients are invested in. We're not affiliated with anyone. We're 100% employee owned. You know, and as you take a look at some of those bullets at the top, if some of those apply to you, you know, feel free to reach out to us.
Yeah, for full disclosure, I do have monies invested with Nightbridge Asset Management. Love them. But again, I think the key issue is, you know,
Kurt, if your next slide is your contact, go ahead and go one more.
Yes. Oops.
Thank you. Okay, go ahead, Pete.
Yeah, the key is fee only, fiduciary, and making sure that you have a financial plan, and so that someone understands your particular situation. So thank you for the excellent presentation today, Kurt. Love it. And
if you want to
really
stop sharing screen,
Yeah.
we can get rid of the black box.
Yeah, we'll have to figure out what that black box is, and we'll handle that differently next time.
Yeah.
Okay, I thank you very much, Kurt. We are at 11:30, so I'm going to say, go ahead, Pete. You want to answer the question?
Yeah, we have one other question. Excellent presentation. Great follow-up of last week's stock information. Thank you.
There you go.
Yeah. That's nice when we get that kind of a feedback, because especially in a Zoom presentation, it's very difficult to get that direct contact and feedback. So again, Kurt, thank you so much.
Yep.
Don, thank you again for being God.
Yes, thank you for It's Your Money. We are doing week 7, and thank you very much. And we will see you all next week with
and what are we doing next week?
Your Money in Your Mind.
Yeah.
Yes. So thank you very much. I'm going to stop the recording.